Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. I'm going to give you my financial opinions around a lot of different tweets that I'm reading about. And hopefully you guys are getting a lot of value out of this. A lot of the times I have a little bit different viewpoint than others, and sometimes I get a little bit irritated and I have to share my opinions with somebody, that somebody's you guys. After reading some of these tweets, I just feel like I have to talk about it. So let's go through a whole bunch of different tweets. This is going to be a wide array of different things. I'm even going to talk about health insurance and dental insurance because I'll just give you my opinions around it, and it seems like people are maybe they haven't run the math. I don't know, but let's dive in, and I'll start talking about it. So it's at finding_finance if you want to follow me on Twitter. That's that. So it says patients upset that one root canal treatment ate up their insurance for 2023. They chose a low premium plan. It sucks, but the reality is that they chose this plan. They had three options. And a lot of people, I read somewhere, I was looking in that thread, and they said, "Oh, I always choose the best insurance," or whatever it is. I just want to talk about insurance real quick. Mine is particular to health insurance, not really. Well, I could talk about dental too, but I almost always exclusively choose the low premium, higher deductible plans. My company has three health options. Now, I have a family plan, so my plan may be very different than your plan as an individual or as someone who's just like you and spouse or something. But I'm on a family plan, and our plan, I'm not going to go into the details of it, but I'll just do a very high level thing. Very low premium, very high deductible. And on that plan, they cap each individual at about $7,000 is the max out of pocket for that single individual. Anything above that single individual, they're going to cover it 100% after that 7,000 is met. That kind of changes the dynamics of doing these scenarios where you get a single person, they have a problem, and then it's beneficial to have the low premium, high deductible plan in that type of scenario if they cover $7,000 and on. I can't find very many scenarios where the higher premium plans, at least in mine, are beneficial to the end person. Most of the time, if I were to have a $10,000 problem, or if it were to go and max out, the low premium plan is better. So it's the higher premium plans, the middle plan, and the option 1 and option 2. I have option 3, which is the low premium, high deductible. The middle one's a much higher premium, and then a smaller deductible. The problem with these plans, if they're all high deductible plans, is one, you're stuck with the premium, and no matter what, you're going to eat that premium. You're gonna have to pay for the premium. Then if you have a problem, like a $5,000 problem, you still have to cover the entire deductible out of your pocket first on that high premium plan. So that plan just basically blows with anything that's a low cost problem. That's let's say a few $1,000s in a year, 3,000, 5,000, 6,000. That thing can't make it up because the premium eats all your money. The low premium plan, if you get a $3,000, $5,000 charge, you're good. And if one person encounters a $50,000 charge, you still benefit on the low premium plan because it's capped at $7,000 for a single individual. At least my plan. All the other plans suck because you're stuck with the premium no matter what. Doesn't matter how much money comes out of your pocket. That money's coming out of your pocket either way. The only way that it may be beneficial is that you're paying pre-tax money for that premium. But you can also cover stuff with the HSA or whatever else on the back end. And I don't even use my HSA. I use money in my account, my regular account, pay for it, and leave the money in the HSA to have that grow, because that's a triple tax advantaged account where I can grow it very quickly and make it large and use it as retirement income. It's almost like having a Roth IRA to some extent. But from all the numbers that I've run, and I don't have the numbers here. I've almost always, it would have been beneficial to always have the lower premium plan because you have the ability to not spend it. And now you're playing the statistics game over many years. So if I were to run this scenario for 10 or 15 years, I would benefit more going on a lower premium, higher deductible plan and rolling the dice every single year. Because a lot of those years I'm never going to have to, it'll benefit me to be on the low premium plan myself. This is my scenario with a bunch of kids on it. Then if I were to make the wrong option, so let's say I chose the wrong option and this one would have been better, how much would I have saved choosing the other option? And the most it really is like between $1,000 and $2,000 difference. So I'm like, well, even if I choose wrong, the outcome isn't that bad. So now you're just looking at my thought process. So the thought process is, what could I save on the first one, which could be tens of thousands of dollars, because the premiums difference is so large. It could be up to $100,000 over a 10-year span with premium differences. But if I were to choose wrong in 1 year, what would my benefit be choosing the more expensive plan? The difference is like $1,000 or $2,000. So it's like, who cares? That's been my opinion on it. Choosing option one with the high premium and being right will only save you $1,000 to $2,000 more. There's no upside there, in my opinion. But I just wanted to share that. At least those are my plans, and they may differ greatly for yours. Mike says, available inventories of homes for sale is still falling. Sellers simply aren't keeping up with demand. Inventory of single-family homes fell by 2.5% this week to 418,000. The fewest since last June. The Altus Research Housing Market Video has deed. So look at this. We continue to draw down our inventories for real estate, guys. This here is just a little bit larger seasonal trend moving a little bit higher, but we're still drawing down like we would in most of these other areas. Let's take a look at the thing that he says here. It says, slight increase in the new listings this week, still fewer than last year. Immediate sales picked up too. 18,000 homes got listed, and it went into contract right away. 24,000 last year at this time. There's just no sign of any surge in inventory anywhere in the country. Completely agree. At least someone's on my page. It says consumers are obviously price sensitive, but still buying. The price of new listings is $389,900 now versus $399,000 last year. Median home price is $425,000. You should see the headlines agree on negative annual HPA in a few months. Yep. So coming on down, here's the surprise. More homes went into contract this week than last year at this time. 69,000 versus 68,000 last year. Lots fewer pendings overall, 426,000 versus 404,000. But a notable sales uptick from last fall's ice cold market, even as mortgage rates are at 7%. And I talked about this before, that mortgages and the rates going up may not have the impact against the buyers than what most people think. The housing market may be more resilient than what most people think. And I'm still in that camp. I need to see the data change and convince me otherwise. But it's still looking very positive for the housing market. It says price reductions data confirms obviously cooler market, but not tanking from here. 31% of the homes have taken a price cut recently. It's really hard to see the most dire predictions for the housing market being realized this year with supply so restricted. I agree. Price reductions hitting low for the year of 31%. So it is coming back down. But you can see how it usually moves in other years as well. You can kind of see we dip and we bottom out and we kind of come back up a little bit throughout the year. It says all the surprising details in this week's Altos Research Real Estate Market Video. Buyers continue to outpace sellers and inventory keeps falling. Wednesday, 3:15 is our next webinar. And he goes on with that stuff as well. So the housing market, stronger than expected, I think, than what most people are expecting. I also wanted to touch on this one. So Warren Buffett, and I agree with Warren here. I don't agree with Carter McClung. It says diversification may preserve wealth, but concentration builds wealth. So diversification preserves it. Concentration builds it. Concentration is what I did at the bottom of 2020. I concentrated a lot of my holdings into oil and gas, basically into energy is what I did. And it built a lot of wealth, a lot. I was heavy in natural gas producers and oil producers, same with uranium. And in 2020. And it did very well. And this guy, I don't know, we'll see what his argument is. He says, your gut response may be, but if I bought 10,000 of Apple stock in 95, my annualized rate of return would be 26% and would be worth $2 million today. Sure, but you're missing something. Concentration may quickly build wealth, but it also quickly destroys it. JP Morgan put out a paper called The Agony and Ecstasy: The Risks and Rewards of Concentrated Stock Positioning. In their research, they found the following. Using the Russell 3000 since 1980, roughly 40% of all stocks have suffered a permanent 70% plus decline from their peak value. Tech, metals, and mining had losses greater than 50%. The median stock return since inception versus the Russell 3000 index was minus 54. Looking under the hood of the S&P 500, the returns of the individual stocks that make up that index are highly skewed. As an investor, the best way to protect against the risk of permanent loss of capital is through building a portfolio that combines these risky assets. Your portfolio determines the majority of your current and expected future return. They revolutionized portfolio construction, emphasizing the importance of asset allocation, discovering 94% of the total return variation was solely from asset allocation. Yeah, I agree with that. That 94%, the total return, agreed. It says this places importance on what you hold over your skill to time the market or to pick stocks to generate market returns. The optimal asset allocation will depend on your goals, time horizon, taxes, liquidity needs, and risk return objectives. The goal of your optimal asset allocation: construct a portfolio that gives you the highest return per unit of risk. In practice, how do we achieve this? Totally agree with this, though. Construct a portfolio that gives you the highest return per unit of risk. And I've talked about this a lot on our website, a ton. A lot of people, they want to go after high returns, but they're taking on too much risk. So you want to do a ratio and you want to maximize your returns per unit of risk. Completely, 100% agree with this part here. It says, looking backwards, this is easy. I can just backtest and select the securities that generate the highest returns with the least amount of risk. Looking forward, this is hard. The difficulty is no one knows which asset class will perform the best. And that's where the ratio analysis comes into play. It says, therefore, we must build a portfolio that best captures our expectations of what future returns will look like. This is hard because what performs well this year may not perform well next year. I agree with that. It says, think large stocks will provide. So he goes into all this other stuff, and I don't think it's too much value there. But what I want to talk about is, if you can figure out what assets can do well, given the market conditions, what you want to do is you want to combine the 3 or 4 things that we talked about here. You want to concentrate on those sectors that have the best risk reward. And you can do that by ratio investing, looking at ratios, looking at the market conditions, and then honing in on those companies that are really down and concentrating some of that wealth into those areas. And then, since we know where the best sectors are and the market conditions and where the best risk reward. So this is the highest return per unit of risk. The way that you're mitigating your risk is you're mitigating your risk by when you buy it. That is how you make a lot of money. It's not about portfolio allocation to certain sectors. I mean, it is, but it's when you buy it. It's your entry point. And you can concentrate on what would be highly risky, highly volatile companies, but you take that risk when all the risk is sucked out of it. That's where your returns come from. Your highest returns come from companies that have a gigantic amount of leverage to the upside, and your risk is when you're buying it, it's very, very low. Now, your risk can still be high in terms of maybe a company that could potentially go bankrupt. So the risk of bankruptcy could be there, but that's how you get the potential of these outsized hunter baggers. They get sold off to pennies on the dollar because people think they could potentially go bankrupt. They run for the sidelines, and that's when you could pick it up if you are good at looking at the market conditions changing rapidly. So a company could be close to bankruptcy because the commodity price goes below their cost curve. But if you are good at technical analysis and you're good at ratios, you can say, okay, we're cheap here. We know that. This company's been blown out to the downside. My return could be massive, but I do have to take on some risk. But the upside potential is so ridiculous per the unit of risk that it's worth risking some money in it. That is what I did. That's how I made my money. I made my money by buying medium to high cost commodity companies at the bottom of 2020. And I did it with the companies that had the infrastructure in place, and all I needed was the commodity price to come back. It was one massive leveraged play against the commodity price. And that's what I did. That's how I made a lot of the money from 2020 onward. So I wanted to kind of share that. It says the national mortgage delinquency rate is near its record low. Look at what happens historically when it has hit a low extreme. It suddenly and sharply spikes higher. Extremes are called extremes for a reason. Now I have nothing against Adam, but I think he's completely wrong here. You got to think deeper than this. This is just a look at a chart and then try to come up with some stupid. I'm sorry, guys. His reasoning is just stupid. It has no logic tied to it. Well, if we hit a low extreme, then suddenly it just spikes higher. Okay, guys. Let's say, and I'm just going to give an example here. All right. Let's say our delinquency rate is incredibly low. Now I'm going to give a scenario here. I'm going to cut back in here. This post kind of gets me a little bit pissed off. So sorry if I'm a little bit mad. If you go into a very tight housing market, which we're in, that's why we have no inventory. If we weren't in a tight housing market, we'd have a bunch of inventory and our prices would be collapsing. All right, with interest rates going up like we are. We're not. That's the whole thing. To think that we are means that you're missing something in the market, because we're in an anomaly stage. We're in an anomaly because we're below 6 months of inventory, which has never had a price decline in history. And we had price declines recently, which means that the market is digesting the large increase in mortgage rates. Now, if the delinquency rate's at all-time lows, there's another explanation. It doesn't mean that we're just going to spike out of nowhere. So let's look at the chart and let's try to use a little bit of logic on this thing, all right? So the national delinquency rate, first lien mortgages, we're at 3.38%. If we look at data, the data suggests that we are short somewhere in the range of 3 to 6 million homes. That is what the shortage is in the homes. If we've got that shortage, guess what happens? All right? So if we have that shortage in the market, it means that people with higher credit ratings are going to buy homes and be better qualified to buy these homes than people with lower credit scores and people who have less down payments and less money. Their income is less. So what's going to happen, in my opinion, is that this will stay down for a period of time. And that period of time that it stays down is because of the shortage in the market and the ability, I should say, and the inability for people to afford homes that cannot afford homes. So you're going to get the best quality candidates or the best quality buyers, however you want to call it, the best quality buyers with the most amount of money buying homes, and everyone else gets priced out of that market. So your delinquency rate should be low because you have a shortage of homes, which means that you're pricing out the bottom 60, 70% need to get priced out of the market. One, through affordability, and two, when people compete for homes and they can sell them at higher and higher prices, it means that the people who can buy these homes have better credit scores, more money for down payments, et cetera, et cetera. Now, what happened back here is that they got rid of all of the credit worthiness. They just started loaning to everyone back here. And that's what led to this large delinquency rate of mortgages. So when you have a bubble and you have too much supply, they're going to sell homes to anybody. They're like, screw it, take this house, just take it. But what if you have very few homes to sell and it's a lot more expensive? You're going to have better, more qualified buyers. So at some point, this will kick up. I completely agree with it. I just think that the market is really tight right now. And I think that it's going to be tough. It's going to be tough for non-qualified buyers to buy homes right now. I think it's going to be very tough. And that's going to keep this delinquency rate, I think, low for a good period of time. Unless we have some sort of like gigantic event like recession, depression, where everyone's just losing jobs, then you can see the delinquency rate really kick up. But I don't think we're there yet. It says net gas working on the bottom. It says buying is the right probability to me. I completely agree. Now, is this the ultimate bottom? I think it probably is going to do a double bottom here. He's probably got that drawn about right. And I wanted to share this because, I mean, people will be saying, oh, it's going to go back down. You shouldn't be in it. It's not a proven bottom or confirmed bottom. Guys, if you just cost average in the entire bottom over here, it doesn't matter. You're going to get the best, lowest price cost averaging in an asset that is incredibly cheap against all other assets. And as long as you can ride through it, you'll be just fine. And I don't like some of these guys that think they can just try. They're trying to try to time the bottom to the nth degree. I just don't think that's a smart way to do it. If something's cheap on a ratio perspective, and natural gas is cheap to basically everything right now, I just think that's a really good opportunity. It also has a Livermore accumulation cylinder: 1, 2, 3, 4, 5, 6, 7, and at the bottom of 7, what you get is this large like hump that comes down. Basically, how he's drawn it in here: you go up, you come back down. That's a big hump. You'll get a lead-in pattern. And then you go up again. And you'll get like this hump, like see these little humps here? You get a hump, you get a lead-in pattern, and then you start to take off again. So give it time. I think it'll be just fine. And even if it stays down for 6 months, it doesn't really matter. You're going to get such cheap shares in some of these natural gas companies. It just doesn't matter to me if I'm a little bit early. Here's URA. I also liked his chart that he's got here. And what we have is a downtrend. You've got a basing pattern, and then we've broken that basing pattern to the upside, and it's consolidating before what potentially could be a big move. And I agree with this pattern. And usually what you get is the upside here looks very much like the way it came back down. So Global Uranium ETF, URA, I think is what this is. Yep, URA looks very good. It says this is simply very big picture setup is coming to a close fairly soon. It needs to make a choice: break out above the yellow resistance and start the next leg up in this secular bull market, or break down below the blue secular bull market uptrend line. So here's your uptrend line from 2001. We're coming on up. We're squeezing on up. And he's saying, is this a halfway pattern where it could be a cup and handle pattern? That's generally a continuation pattern, and hopefully we can break out. There's a little false breakout right there. And I think we're going to move higher based off the market conditions. It's a clean looking pattern here. And yeah, it looks really good. Eric Nuttall, he says, we remain bullish on oil. He says, we are very clearly in an energy supply crisis. Eric Nuttall sees return of triple digit oil. I also think that natural gas will do well if you're a patient investor and you buy at very cheap prices like we were at. And we may stay down here for another month or two, but I think it's a really good opportunity. That's my take on it. Here's the Fed has already reduced liquidity more than in previous tightening cycles post-2000. It's down 23% from its peak. So these are the tightening cycles, 18%, 17%. Now we're down 23%, and it's more than the previous couple of cycles. I thought that was kind of cool. It says, no hype in critical metals investing yet. There's no one there. That's pretty crazy. But I also think that a lot of people would rather watch it online than participate in real. in real life. So that could also be a contributor. It says we'll need more copper in the next 22 years than we've ever mined in history. And this is the copper, the green metal, world consumption of refined copper. This is 700 million metric tons from 2020 before, 2021. And then in the next 22 years, we need another 700 million metric tons over the next 22 years, is the same amount as we've mined already in world history. And I don't know if we can mine that amount in that time frame. I don't know. Here's Connor Scoops. I'll skip that one. So said before, the ratio bottomed in March of 2020. That platinum is going to outperform gold in the coming bull. Pioneering platinum case on FinTwit. I like last week's red circled bullish engulfing candle at support. I like it too. Hopefully we can get a big old run out of platinum in relationship to gold, and they both actually run higher at the same time. I think platinum is one of the best investments there is in the market. And then we also have platinum versus SPX. I do very much like platinum, and that's breaking out against the S&P 500, doing a little retest, and then we'll probably move on up from there. It says breakout of the 15-year bullish falling wedge and very probable backtest. And we're getting that backtest in here shortly. But you can see that the MACD is continuing to move up, and we're about to get into positive territory. Once you get in positive territory, that's when it usually goes up. I don't really use these types of metrics. I use ratios more, and I don't care necessarily the exact timing of it. What I generally do is I buy the bottom of an entire thing. So I might be buying in 2019. I'll buy this entire bottom here and then ride this thing on up. And I'll buy copious amounts because the returns per unit of risk in this metal is very good, in my opinion. Here's Nat Gas, wave one. So he's talking about wave one and a pullback that we could get in a potential move. In the short term, though. Uranium's also putting in inverted shoulder, head, shoulder type pattern. And then we could break and move on higher. So we're still very early in this mix, which is good. And that's what I am going to end on. So that's what I've got for today, guys. Hopefully you enjoyed it. I know I talked a little bit about insurance. At least with my plan, that's what I've calculated out using an Excel spreadsheet in different scenarios, highly likely scenarios as well. But I don't have multiple sick kids. They're pretty much healthy. They do have asthma, whatever, and they do have some problems every once in a while with their breathing because they were premature. I have two premature. They were premature twins. They were 27 weekers. Pretty crazy the costs there when we had them, and they had to go in the NICU and stuff. But every once in a while they might have a flare up, but it's nothing that's major, and they've been pretty healthy. So, lucky me and lucky them. In the markets here, looking at a lot of this stuff, I still think everything looks absolutely fantastic, and we're still very low on ratio charts for a lot of the value of these different commodities. So if you guys have any interest in a lot of these commodities, what they are, what companies am I playing it with, you can see my portfolio. Definitely check out finding-value.com. Join the website. You can use the word discount in the coupon code to get a discount. We have a platinum question and answer session Sunday at 5 p.m. Mountain Standard Time. We'll see you there if you're a platinum member. And if you've been with the website for about a year, I'm going to give you a further discount. Message me about the discount, and I will give you that discount code if you've been with me for about a year. All right, guys, we'll catch you next time. This is Finding Value.